All right, so this is just a quick run through with the put credit spreads, right? So just to run through everything. So we dealing with SPY because SPY tracks the S&P 500, and the S&P 500 is built with all of the strong companies, the strongest companies on the market, pretty much. So basically, any company that is in this ETF, if they are struggling and they don't meet up, add up to the requirements and uphold their withstanding in this particular ETF, then they'll just get removed and replaced with a different company. All right. So basically, what that means is this is designed to continue to go up. Obviously, you're gonna have some dips. No matter what market you're in, there's always going to be a retracement or a correction at some point. All right. So you can see, even though it's been going up, there's always points where you have retracement. Like I said, if you're dealing with moving averages, the beauty about having a moving average here is that you know that the moving average is going to get tested every now and then. So since COVID, the V-shaped recovery, since that, the 50 moving average has gained a whole lot of separation between the 200 moving average, all right, which is a good sign for us. That means we can do put credit spreads all day. So, um, you know that there's going to be small retracements along the way. All right, we had our small retracement last week. Okay, as you can see, this was the 25th, this is the 26th, and then we opened up Monday back in order. Okay, so I had did a credit spread for Friday, and I got into a credit spread on Friday when I saw that it had slowed down. I figured that it was a shaky position to be in because we had those two bad days, Thursday and Friday of last week, due to the bond yields rising a little bit. Um, but then at the same time, you had the stimulus news, so everybody knew that the stimulus stuff kind of got pushed through. So that's good news for the markets. As you see, what happened the last time they passed the stimulus, all this gains, came afterwards. So I knew that it was going to be either one way or the other. But I was pretty confident in jumping in there because my strike price was like 276 or something like that. So either way, I had my strike under, a good amount under um, where it's actually closed at anyway. So I was okay with that. And then as you see, Monday we opened up high, and then we closed high as well. So my contract expired out of the money, so I'm cool. If you're trying to figure out exactly how this stuff works, just to make it easy for you, when you're dealing with put credit spreads, you have a bullish outlook on the market. So you want to make sure that your strike price is below the structure. All right, I would just tell you to keep your strike price below structure because if you have that, if you have your strike price below structure, then you can pretty much bank on the market going in your favor. And if it happens to go against you, at least you give yourself some space to get out of the trade to where you don't lose all of your money. Because if the price goes all the way down to and meets your strike price, then you're gonna lose all of your collateral. All right. And then also you risk the chance of the other side being exercised. So you selling the put and then you're buying a put at the same time. Knowing that when you sell a put, basically what that means is you have a naked put, which in most cases you would have to have all that money in collateral. Okay. So let's just say for instance you had a $382 strike price when you sold, and then you had a 381 strike price when you bought. Okay. Now this is a put credit spread. You see that, all right, right here. So that's how you know that you're doing it right. If this is not up here, then it's in question. You need to make sure you got everything in order. If you don't see this, okay. So we verified put credit spreads. You see that, right? So these are your two strike prices. The current price is 390.17. If the price happens to start going down, you're gonna be in the negative, but it's not gonna take all of your money until you actually get all the way down to 382. Now, if it gets close to your strike, I would advise for you to set some alerts to where it gets to like 384 or 385, just to let you know, like, okay, now you might think about you might want to think about getting out of the trade. Because if it gets any closer, then remember, you're selling the put and you're buying the put. So in normal circumstances, when you're selling the put by itself, you would need to have $3,820. I'm sorry, $38,200 in your actual account. Because once the strike price meets the share price, they can exercise the contract and you're obligated to buy 100 shares because you agreed to this contract. The reason why it's not being upheld up until this point is because it's a spread, and they understand that. But once the price actually comes down, then it's almost like all bets are off. You still could possibly get exercised. So the key to it is making yourself a note or set an alert or understand that you need to be monitoring this, because if the price gets too close to your strike, you have to get out of this trade. Don't give the other side an opportunity to exercise on you. Just get out. All right. So when you get out, you're closing the trade. So remember, you selling the put and you're buying the put. If you want to get out of this particular contract, you need to buy this contract back. Okay. So it's going to cost you money to get out. That's first. Then on the other side, when you bought a contract, you bought a put, you need to sell that to close that. Okay. So you're doing the opposite to get out. But in Robinhood, it allows you to close the whole spread altogether. All right. Whether you're on your phone or you're on your computer, you'll have the option to close the entire spread altogether. All right. But sometimes people like closing them one at a time for whatever reason, because obviously one is going to be winning and the other one's going to be losing no matter what. So if this one is winning, then you can go ahead and sell this one, get your money, and then buy this one, all right, and spend that money to get out. Okay. Either way, you still keep the premium. The premium's already in your account. So in some circumstances, if the price goes against you, you might have to use some of your premium to get out as well. You feel what I'm saying? But as long as you don't allow price to come all the way down to your strike, you won't have to worry about losing your whole entire collateral. All right. But do it strategically in a way to where you have enough space in between. So the reason why I came all the way down here is because you can see the percent chance right here. The percent chance of you actually expiring out of the money is 90%, 88%, 90%. The farther you get away from the share price, the higher this percentage is. So that better your chances of actually expiring out of the money. And you want to expire out of the money. All right. If you expire in the money, then that means that you're probably going to get exercised. All right. So you want to expire out of the money. So give yourself the best chance by staying within the 85 to 90 something range with the percent chance of you expiring in the out of the money. All right. When we talking about dealing with the charts, you shouldn't execute any of this stuff without putting it on the chart first. That's first of all. So you see the charts, you see the structure of the chart. All right. You can even utilize the you can even look at the pivots. All right. And I used the pivots when I got in. So if you look at the 4-hour chart with SPY, and we take this back to Friday. All right. This is Friday right here. I came in, my strike price was under the support. So this support level 3, I made sure that I was under the support and I was under the 200 moving average. So I have all the support. I got this 200 moving average, which hasn't gotten crossed. Yes, price came down, but it didn't close under the moving average. It actually closed above the moving average. So I made sure I was under that. And then I had a support level 3 here. I made sure I was under that too. So I gave myself the best chance. Now, knowing that SPY is designed to go up, the probability of this thing coming all the way down past support, past the moving average and all that on Monday, it's very, very rare when you got news coming out talking about stimulus is being passed and all that other stuff. So I was confident. Even though that's risky, I was confident, okay? So I took some money. You know, I did 30 contracts. And I only got like probably less than $200 because of how far my strike prices was, but I did 30 contracts. Okay, the one before that I did like 15 contracts. All right, ended up getting like $400 and something. So My whole goal was to make sure that I'm utilizing the put credit spreads to offset any losses that I might take when we're doing earnings calls. All right. As you know, a few weeks ago, we got into Walmart and we ended up losing some money. All right. I lost probably like $400 or something with Walmart, but then I made it right back with the put credit spreads. So that's the beauty of having different strategies. So where you could at least offset some of your losses. And then if you end up winning on both sides, then now you came out winning all the way around. Okay. And all that cash flow just gets transferred into my traditional brokerage account, and I'm ready to go and buy some shares of a dividend paying stock and continue building my portfolio. All right. So you utilize the pivots to let you know where the support is at, so that you can at least have a strike price below support, below the moving averages. All right. And then when price starts going the way, the direction where you want it to go, now you feeling more confident, and you know that you're able to close the contract. Now you can actually close the contract before the expiration date. If you're feeling like you don't trust the situation for whatever reason, things start going against you, or you just you panicking or whatever, you're not settled as far as your nervousness or whatever, you can close the contract early. So let's say, for instance, I got credited $200 on this. You're not going to collect the whole $200 until price either gets all the way up into the point to where you in 100% profit zone, 100% ROI, or you wait until the contract expires out of the money, and then you collect your maximum profitability. All right. If those two things don't happen and you still see profit coming and you don't want to wait until expiration, you can actually close the contract and just walk away with whatever gains you made. So let's say, for instance, I got credited $200, but when I'm looking at my Robinhood account and I'm looking at the contracts, it says I'm in profit like 150. All right. If you see that and you like, man, you know what? I think I'm going to just go ahead and close this and get out of there. Then you can actually close out and collect the $150 profit. You feel what I'm saying? So that's something that, I don't think I discussed before, but you can close the contract early and just take whatever is there instead of realizing your maximum amount of gain. All right. So that's something that you want to keep in mind. But that's the whole reason for us utilizing the put credit spreads, is to make easy cash flow. All right. The SPY is designed to go up. Yes, it does pull back. Okay. But when you're in a situation like this, where you're going from, what's this? You're going from February 2nd all the way till February 21st, February 19th, you almost got damn near a whole month of upward movement. Then that means that you could get paid. You could get paid, they do contracts like every 2 days. So you got the potential to get paid damn near 10 times, you know what I'm saying, during the whole month, 12 times during the month. So if SPY is moving the way it's supposed to be moving, like back here, then you can get paid 12 times a month. If you decide to go in and get a contract every single expiration, you can stretch your situation out to where you can actually do that if you wanted to. As long as you have the collateral, you can get the cash flow that you need to continue to keep the money coming in, and then you can make sure that you have something to offset any losses that you might take when we're dealing with more riskier trades. All right. So the other thing that I want to make sure that you understand, right? Call credit spreads. All right. Call credit spreads. I never really talked about this because I didn't feel like it was necessary at this particular point. But let's just say, for instance, we wake up tomorrow and the market is about to take a huge dip. The bond yields is up. You know what I mean? The interest rates are going crazy. There's been a spike in COVID. The vaccines ain't working. Whatever the case may be, it's making people nervous and the market is going crazy. Bitcoin's going nuts. Whatever. Let's just say, for instance, SPY just starts taking a huge dip. Well, we have call credit spreads for that. So call credit spreads allow you to make profit off of a bearish outlook on the market. Okay. So when the market is going bearish, Now you can utilize call credit spreads the same exact way. So in this particular case, let's say for instance you was looking at SPY and you saw that it peaked out right here February 16th. All right, some bad news came out and things is going down. Or you feel like, okay, you know what, it's looking like it's about to retrace. Normally it's going to retrace and it's going to go down and test the 50 moving average. It might possibly test the 200 moving average. I'm going to trade this thing until it touches the 50 moving average. Some people do that. All right, so you can make money going up and down and still stay with SPY if you choose to, because you know that it's going to continue to go up. But even on the uptrend, it has these pullbacks. So you can make money on the pullbacks, or you could wait for a disaster to happen and put yourself in a position to make money on the way down too. So call credit spreads, you're doing the same thing, all right? You selling the call and you buying the call. Same thing. You still got the expiration dates and everything there. You're still going to need collateral. All you doing is you coming in here and you putting yourself in a position to make money on it going in the opposite direction, all right? You're going in the opposite direction. So you're looking at this thing from the opposite direction and you want the price to stay under your strike price. So if you know that the price is going to continue to go down, then you will come in here and you will get 395, and then you will turn around and go 396. All right. And then you do the same situation. Okay. You're getting your credit, however many contracts you want to do, however much collateral you got. Now obviously, you know, it's SPY. So the spreads between these two contracts is only $1. So $1 multiplied by 100. So each contract, you're going to need a $100 deposit as collateral. So every time I put a 1 on here, that's $100. All right. So if I go all the way up to 30, that's $3,000. All right. You know what I'm saying? So you have to judge. You know, I put 15. That's 1,500. All right. So you have to judge how much you want to put up as collateral. But same thing. All right. So when you're doing call credit spreads, you want the price to go down. When you're doing put credit spreads, you want the price to go up. You never want the price to touch or even get close to your strike price before expiration. If it starts going towards your strike price and you see your options looking negative, then you have the opportunity to get out before you take on the whole entire loss, and then you can reposition yourself if you choose to. All right. So I hope I broke that down good enough. Also, if you want to take it that route, you can go in here and use the options profit calculator just so you can see where you at. All right. You go up here and you go put credit spread, put credit spread, call credit spread. Right now I'm on put spread. All right. You pull up SPY. All right. You pull up SPY and you see where the option is. You got the put, you got the long put, you got the short put. The long put is when you buy the put. So buy put. That's the long put. All right. Find out which expiration you're dealing with. Go to your strike price. Okay. Whatever your strike price is going to be, let's just play around and say it's 386. Make sure you're on the put side, obviously. All right. So let's do 386, 112. Okay. And then you got the short put. All right. Short put, same thing. You go over here, you want to make sure that you want 387, right? 387. So you want to make sure your short put is strike price is above or more than your long put. Okay. That's how it is in Robinhood. So make sure you got the same situation going on in the actual calculator. Okay. It'll update itself and it'll let you know what your credit is. And then you calculate it and you can see that the maximum amount that you're going to get is maxed out. Now, look what happens if you get out early. You see? You know what I'm saying? When you get out early, this is what you're dealing with, okay? When you get out early, you didn't realize your whole potential profit. Your potential profit was 220. But if you get out early, you will be able to collect a less than that. But if it hits your expiration, then you all 220. You feel what I'm saying? So if you get out early, you can collect some money, but not the whole amount. But if you wait till expiration, regardless of where it's at, as long as it expires out of the money, you're gonna get the whole 220. All right. So you could pull it up on the options profit calculator just so you can see it, but then you also see how much you can potentially lose here. All right. You could potentially lose 750. What is that? 780 if you allow it to go against you All right, but knowing that if it goes against you too much, then you might get exercised and lose even more than that. Okay, so that's that's the whole breakdown on that. Using the profit calculator, using the chart. Make sure you always chart it up. And then also, what I do is when I'm during the day when I'm monitoring all of my trades, I'm monitoring all of my positions from the 15-minute chart because I can see the movements on the 15-minute chart. All right, and then I can pull up the daily pivots and mark my take profits and my stop losses on the daily pivots throughout the day. So I was watching SPY from the 15-minute chart on the day. All right, I came in down here. You know what I'm saying? Or really, my strikes was down here. All right, but I had my alert set around here. So I know that if it starts breaching the moving averages, then I look like I might be in trouble. But as long as price is above these moving averages, I'm not worried about it. Then once I saw price get to the resistance and start going above resistance, I'm like, okay, cool. I'm about to get my money back and I'm good. All right, so monitoring your trades on the 15-minute chart during the day is probably the best thing that you could possibly do because now you can see the movements against the moving averages on the pivots and everything is there as far as your RSIs and stochastics, just letting you know how things are going. Also, keep in mind the SPY trades after hours. All right, so just because you ended the day on a good note doesn't mean that, especially let's say, for instance, you got an expiration date that expires tomorrow. Well, SPY is still trading. As you can see, the clock's still ticking. The price is still moving. They trade after hours. So you might be good when you close up on 4 o'clock, but you might come back around here at 9 p.m. and see that price is going down. And you might, you know what I'm saying? You might get nervous. So just know that SPY, it's not going to be a lot of volume after hours, but it does trade after hours. So that's why it's important to make sure that you give yourself space on your strikes. Don't play it too close, just because it's more profitable for you to get a closer contract to the share price. Yeah, the closer I get, I'm gonna get more premium, but the more riskier you're gonna be because first of all, SPY continues to trade after hours, even though it's low volume, it continues to trade. But you just don't want to play it that close because remember, if it gets too close to your strike, you're going to lose money and then you potentially get exercised. Don't even put yourself in that situation. Just give yourself space. All right. If it ain't a whole lot of premium, so what? At least you're making money. All right, but just don't risk it. This is the safest. We want to make this. This is the safe thing. This is the safe way to play it. Don't turn it into risky when you don't have to. All right. If you want to get more premium, then you just need to put up more collateral. You feel what I'm saying? Don't make it risky to the point to where you have your strike so close because you're trying to maximize the potential premium you're going to get. You're risking it. This is supposed to be the most lowest risk that you could possibly take because you're not paying a lot in collateral than you normally would, and you're not risking a lot, and you're getting damn near definite gains with premium up front. So don't turn it into a risky situation when you don't have to. Play it safe all the time when you're dealing with credit spreads. All right. Hopefully I could answer your questions. And if you got any more questions, let me know. All right.